Ladies and gentlemen, welcome back to the channel. As I shared with you in the prior video, there is three major developments today for Tesla stock. There was a hit piece by the Financial Times that FSD could be delayed into entering the Chinese market. I don't really think this is something a lot of Wall Street has been paying attention to recently. The fact that FSD was supposed to go into the Chinese market, just judging off of the decline for Tesla stock. But this hit piece is interesting because there's, again, no sources cited, and there's this is really more like an opinion piece. So I don't know how much it'll affect Tesla stock versus the other two things that are being reported today. And the second one of which is the Model Q, as what a lot of people are calling it, is actually ahead of schedule for their expected launch, or its expected launch in Q2, which is interesting because, as I shared with you in the last video, if you have not seen it, go check it out. Joe Tetmeyer, which does the drone flights over Giga Texas, actually shared on February 14th, a couple of days ago, that on the third story of one of the newer areas of Giga Texas, there is a new production line being installed. And 3 days later, we get this news that the Model Q is actually advancing faster than expected. Not to mention that video that came out with Franz like a week or two ago, showed a covered vehicle in the background. Now, a lot of people said this was probably a cybercab, which that doesn't make sense to me. Why cover up a vehicle that is already known to the world? I suggested this could be the lower, cheaper price Tesla. And maybe there's actually some prototypes already built. This is very positive developments for Tesla stock, in which a lot of the story that Wall Street has clung to is the deployment of these cheaper, lower priced Teslas. We will see how this news affects Tesla stock coming this week. And finally, we had news today that Elon Musk said the Model Y is selling like hotcakes, or is expected to sell like hotcakes. This is something not a lot of people picked up on. Elon Musk shared a tweet from Tesla Economics that says the Model Y is going to sell like hotcakes. And we did get news today as well that wait times for the Model Y are being pushed out. So it's taking longer to get your hands on a new Model Y. I would argue that Tesla is not really having a production issue with these new Model Ys since they are rolling out of Giga Texas. But in fact, there is a lot of demand for the Model Y that is extending the wait times. I will also make the argument that you're not seeing brand destruction by Elon Musk at Tesla, that is really overblown at this point. It's like cognitive dissonance, where we pay a lot more attention to the smaller group that is essentially mad at Elon and boycotting Tesla, whereas the masses actually are highly in favor of what Elon Musk is doing with Doge. So it's like we pay a lot more attention to the 10% that don't like what Elon is doing, but we pay very little attention to the 90% that very much agree with Elon, and we sit there and call it brand destruction, which I actually think Elon recently may be improving the Tesla brand, that we won't actually see any brand destruction at all. That's just not even going to happen, which sounds crazy to a lot of even maybe you guys. Let me know what you think down below in the comment section. Now, here in this video, we will discuss your major events coming this week for markets, not just for Tesla stock, but for broader markets as well. We'll look at earnings, economic data, and what could be big drivers this week. Keep in mind, we are entering into the worst 2-week stretch for markets since 1928. So, like, historically speaking, the next 2 weeks could be a little choppy. But first, before we get into all of this key information, only about 50% of you guys are subscribed to the channel. My gosh, if you like Tesla, if you like the information provided here for free 99, hit that subscribe button. It helps to push these videos out to more people that desperately, I would say at this point, need to hear them. Just look at X, look at, go to a post that is bashing Elon and look at the comments, and you're going to see a lot of people, some of which owning a Tesla, that are very misinformed of what's going on right now. And a lot of investors that are clearly not seeing things correctly. And hopefully this channel helps to put a little bit of neutral perspective on things, just to again, be fair here. At least I try to. So thank you for doing that, and let's get started. First and foremost, about an hour ago, Sam Altman posted on X, he is the CEO of OpenAI. He says trying GPT 4.5 has been much more of a, quote, feel the AGI moment among high-taste testers than I expected. This could be a catalyst for some of your software names, some of your data center names, and maybe some semiconductors coming tomorrow. Taiwan is considering a multi-billion-dollar weapons purchase from the U.S. Fed Bowman says she is monitoring supply chains, signs off pent-up demand for inflation risk. This one is pretty interesting. Fed Bowman says high asset prices may have impeded progress on inflation. Fed Bowman says labor market not tight due to slower hiring, but unemployment remains below full employment estimates. She says that patience on rate cuts will allow more clarity on impact of administration policies. Fed Harker says that he does not see liquidity tight enough to halt balance sheet wind down. What's actually interesting about that, though, is the reverse repo market is hitting the lowest levels you have seen in years. Pretty much since the, amount of overnight repos surged during 2021. You're down to the lowest levels here. You were over trillions of dollars. But now you're getting down to the last one we had, February 14th, was $58.77 billion. As this thing continues to fall, you are going to see the end to quantitative tightening. And that's essentially going to put less upward pressure on bond yields. He says the lack of clarity still surrounds an endpoint for balance sheet wind down. The fact that they are talking about that, though, does mean I think it's closer to ending than not. Fed Harker says the Fed should move to all or mostly Treasury bond balance sheets. He says inflation is moving slowly down, but there are risks. And he says home insurance prices continue to rise, and that is a challenge. Fed Harker says the current economy argues for a steady rate for policy for now. Fed Harker says inflation is elevated and has been sticky over recent months, and the economy is functioning from a position of strength with labor markets that are in balance and back to 2018-2019 levels. He also reiterates what Fed Bowman says that, the government's policies, Washington's policies, they have no idea how that's going to affect the economy, so waiting to see what happens makes the most sense. Fed Harker says, I see inflation back to 2% target over the next 2 years. Fed Harker says Fed policy stance should continue to lower inflation, and monetary policy is in a good place right now. So really, there is no talk about raising rates. We are far from that, even though there's like a 20-25% chance this year that the Fed will be raising rates. I think there's a high bar to get there, and we would have to see, some pretty dramatic spikes in inflation to actually get that. Fed Harker says future Fed rate policy choices will be data driven. State Department spokesperson Bruce says talks between the U.S. and Russian officials are about determining what's possible, and they are set to meet over in Saudi Arabia here in just the next couple of days. Mexico's economy minister travels to D.C. this week, says Mexico's President Sheinbaum. This week, we do have some important earnings, and we've really gotten like 70% of earnings season out the way so far, but there is still some important companies. Now, tomorrow morning, you have Baidu, GeneX, Medtronic, Exum, Conagra Brands, some others. Tuesday and after hours, you have Arista, big AI, software name that's done very well, just continues to go higher. Oxy, Devon, Toll Brothers, Cadence, another one of those off-brand AI names as well. Wednesday pre-market, you have Etsy, SolarEdge, Garmin, Wix, Fiverr, Tech, Analog Devices, and Wingstop. Wednesday and after hours, Carvana, Toast, The Cheesecake Factory, BioMartin, Exact Science, Bosch Health, Vail, and some others. Thursday pre-market, this is the big one. Alibaba for a lot of the traders recently, but really Walmart. Walmart will tell us definitively how the consumer is doing. And really in the past year or two, I have placed a lot of weight on Walmart because, what happened back in 2007 in like April, essentially like this quarter, like February, March, when Walmart reported, they gave a really poor full year outlook. And that was the first real big warning sign. The markets were down 3% the next day and continued to kind of trade lower over the following couple of weeks. Because again, if Walmart is warning you that the consumer is pulling back, that's an issue. So I think that's the same kind of scenario we are in now. Walmart has done very well in the past couple of years. Inflation has benefited Walmart because people are shopping at Walmart for lower prices. If Walmart has anything worrying to say, we want to pay very close attention to that. And I think Wall Street will as well. I actually think Walmart in and of itself, their earnings, is a massive catalyst for markets. Like more so than some of your other economic bellwethers in the past, like FedEx and UPS. Those have been seen in the past as economic bellwethers. I think it's really Walmart and like Walmart only. So if Walmart has good or bad guidance for this year, is going to tell us a lot about where the economy is. And usually the economy evolves in ways the data just doesn't pick up on. Like what's going on right now in the economy probably won't get picked up in the actual economic data for many months because there's such a lag, way of calculating the data. And it's just not a really good data calculation tool anyways, the economic data that we get. Now, and also considering retail sales for January came in at almost -1%, the lowest retail sales month over month number we have seen in by far the last year. Let me see if I can go ahead and pull that up briefly. Like it's really bad. I mean, you came in at -0.9%. This is much worse than anything you've seen in the last year. So that did get some people concerned. And whether or not, there's an actual issue here, Walmart will tell us. Now, Thursday and after hours, Mercado Libre, Rivian, Block, Newmont, InnoData, Booking Holdings, Texas Roadhouse. I was thinking of Texas Instruments for a minute there. 5-9, Dropbox, and then Friday pre-market, you have some smaller names, usually not too important. So Thursday is the big one with Walmart. And that's a huge catalyst for markets. Now, as far as economic data, obviously today is Monday. You had some Fed speakers, Fed Harker, Fed Bowman. You'll have Fed Waller at 6 p.m. tonight. He does tend to be a little bit more on the dovish side, so we'll see if that kind of boosts the futures market later tonight. But tomorrow morning, we will get Fed Daily that speaks at 10:20 a.m. and New York Empire State Manufacturing Index, expecting this to really improve from last month's -12.6. We're only expecting a -1 reading, so expecting big improvement there. Fed Bar speaks at 1 p.m. 52-week bond auction at 1 p.m. as well. You do get the balance of trade out of Japan, exports year over year out of Japan as well. Wednesday, we are going to get building permits preliminary data. Now, the simplest way to look at this, it's highlighted in red like it's a big catalyst. Usually it's not. If we see more building permits, that usually translates to markets expecting less inflation, right? Because more building, less inflation. More houses, less housing inflation. Housing starts, you're expecting those to actually fall from about 1.35 million in January or in December, down to 1.39 million in January. So something to watch for as well. You will get the FOMC minutes that come out on Wednesday. That's kind of a transcript of the last Fed meeting, not word for word, obviously, but it kind of reiterates the main points that the Fed wants markets to understand from the last Fed meeting. And sometimes it moves the market, sometimes it doesn't. It doesn't tend to be a long-lasting catalyst for markets, though. 20-year bond auction will be coming out at 1 p.m. That is very important, considering Doge and the cost-cutting efforts in Washington. D.C. is what looks like in a recession now. Average home prices are collapsing in the District of Columbia, the D.C. area. So 20-year bond auction. Do we see good demand or bad demand? If we see good demand, yields are going to fall. That's going to push down 10-year Treasury yields as well, because this is a longer dated bond auction. So good demand, push down 10-year Treasury yields. That's going to make for a pretty good day on Wednesday. That's going to be the big catalyst. And then at 5 p.m., you have Fed Jefferson that speaks also. On Thursday, as you always get, initial jobless claims, expecting 216,000. Last week was 213,000. You could probably come in a little bit higher than expected here, just given what's going on in Washington. That's going to start to add to things, and the surrounding areas probably are not doing too well as far as the job market. It's being reported 250,000 people have already been fired or laid off from the government. You will get Philadelphia Fed Manufacturing Index as well, expecting that to come down a lot from last month's 44.3 down to 25.5. Continuing jobless claims, Philly Fed business conditions. We don't have estimates for that, but you can see the prior numbers here, and you just want to see, do they come in higher? Do they come in lower? Generally speaking, the numbers coming in higher is good. Besides prices paid, you want to see prices paid go down. If the other numbers come up, like new orders, employment, capex, business conditions go up, and prices paid goes down, that is going to be a very positive for markets coming Thursday. You will get the CB leading index as well month over month, expecting that to come in at 0%. 30-year tips auction expected around 2%. That's kind of one of the Fed's things that they look at for inflation expectations being quote unquote well anchored. We've all heard that before, and you're expecting a 2% reading for those Treasury inflation protected securities. So on Friday, you're going to get existing home sales. Real estate doesn't look too great these days, so there's more supply going on in the market, so that could boost some of these numbers. Be on the lookout for that. You will get S&P Global composite PMI, manufacturing PMI, and services PMIs. Across the board, you're really expecting things to get a little bit better here. So if you do see things come in on the low side, that could boost up 10-year Treasury yields. That could, make markets have a good day on Friday. Really, you want to see slightly weaker economic data right now, but not recessionary economic data. Recessionary economic data is not going to be good for markets. Slightly weaker economic data is going to be good for markets. Now, inflation expectations from the Michigan survey here last month skyrocketed to 4.3% from 3.3% the month before. It's a lot of Democrats reading the news. They have hyperinflation expectations, 5.5% or so on average for Democrats. Independents are at like 3.2% inflation expectations over the next year, and Republicans are at 0.1%. So Republicans expect no inflation, Democrats expect hyperinflation, and independents expect 3.2% inflation. So odds are you probably see this number come down in the final number, just considering that heavy bias skew with the Democrats. At the time of recording this video, the futures market that was open for a little while this morning actually shows some positive gains for indexes heading into tomorrow. Dow futures up 0.25%, S&P up about 0.25%, and the Nasdaq up 0.18%. You can also see oil futures look like they are up almost 1%. Keep in mind though, the second half of February is the worst 2-week period for the S&P from 1928 until today. And usually it's literally like this week that markets start to trade lower. Now, that doesn't mean it has to happen. There has been good, second half of February's over the last, 100 years or so almost. But it just says more times than not, it's a weak period. Now, good news is after the second half of February, you head into the first half of March, which is historically a very good period for markets. You can see that right here. Second half of March is pretty much flat. And then you get into the first half of April, which is the third best 2-week period for markets. So if we do get some seasonal weakness in the next 2 weeks, once we get out of February, March tends to be a pretty good month, and April tends to be a really good month. So short-term weakness could happen, could be in the cards, and then the next 2 months following historically are pretty good. I also find it very interesting that we're literally tomorrow heading into the worst seasonal period for markets since 1928, at least a 2-week seasonal period. And the S&P is in a technical breakout, okay? I don't know how many times that has happened or what the correlation is when it does happen, but you're clearly in a technical breakout, right? You had this downtrending trend line, very obvious from January 24th, almost a month now. You found resistance here 3 times, 1, 2, 3. You broke out on Thursday and held that breakout on Friday. And usually when you get a breakout like this, a technical breakout, it usually tends to send markets into a new trading range. Like not just a small breakout and then you come back down. It usually is like a 2 to 3% move higher, then you kind of trade sideways. That's what happened from the technical breakout here from December 6th until January 16th. So over a month, you were kind of trading sideways, trading lower, okay? Then what happened? You broke out above this trend line. From the break of that trend line, you went up 2.5%, roughly. Well, if that happens again from the break of this trend line, 2.5% is going to put the SPY in the 620s, around 622, 623. And we'll see if that happens over the next 2 weeks. I don't think there's enough to just say seasonality is bad, so that means we're going to fall. Worth considering, but also technicals don't lie. We are in a technical breakout right now. Also worth mentioning is we are at multi-year highs for the bearish sentiment. Investors have not been this bearish on markets since like early 2023. So we've seen Nvidia fall almost 20% in a single day, literally questioning the whole AI trade as we know it. We've seen a yen carry trade blow up. NASDAQ was down like 6% in pre-market that day, almost hit a circuit breaker. Hasn't happened since the COVID crash in March. You've seen banking crises, right? And we're more bearish now than any of those other times. That just doesn't make a whole lot of sense to me. Bearish investors at 47.3%, neutral at 24.3%, and bullish at 28.4%. If we were bullish heading into the seasonal weakness, I would be a little bit more bearish. But considering we're already so bearish, it leads me to be a little bit more on the bullish side. Percent of stocks trading above their 50-day moving average, same story at 51.37%. That's not a super optimistic market. Half of stocks are currently in a downtrend. CNN's Fear and Greed Index sitting at 44. You are in fear territory. Market momentum is neutral. Stock price strength is fear. Stock price breadth is fear. Put and call options greed. Market volatility is neutral. Safe haven demand in fear, and junk bond demand currently in greed. So now that you have all of this information, let me know what you think about it down below in the comment section. Are you bullish? Are you bearish? Are you kind of neutral? You don't know what's going to happen here over the next couple of weeks. Let me know your thoughts down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.